All right, let's get right into it. We are looking at Grindr, ticker GRND, and it is having an absolutely explosive session. The stock is currently trading at $15.06, which is a staggering move of $2.39 or 18.86% to the upside just today. Now, the moment most people see a pop like this, especially in a volatile post-SPAC name like Grindr, they immediately think it's just retail speculation, perhaps a meme stock surge, or a low-float short squeeze. But the reality is, this is not a random, baseless move. This is a direct and powerful reaction to the quarterly earnings report that just hit the wires, and those numbers are telling a story about monetization and profitability that the market had clearly and severely underestimated. For the better part of a year, the common belief, the market expectation for GRND, has been one of stagnation and high risk. The narrative was that Grindr, while being the dominant player in its niche, had a user base that was largely mature, especially in its key North American and European markets. The assumption on Wall Street was that its ability to convert free users into paying subscribers, those on the extra or unlimited tiers, was hitting a significant ceiling. Analysts were concerned about its reliance on advertising revenue, which is notoriously cyclical, and the constant overhang of privacy regulations and platform safety concerns. It was being priced as a low-growth social media app, not a high-growth subscription business. This morning's report just took that entire bear narrative and threw it out the window. The reality, the data, shows that management isn't just treading water, they are executing with precision. The key headline here isn't just the subscriber count, which was good, but the average revenue per paying user, or ARPU. This figure is climbing. It shows Grindr has pricing power. It shows they can successfully upsell existing users to higher margin tiers. This move today isn't based on hope, it's based on math. The company is proving it has levers to pull for growth that the models simply got wrong, and that fundamentally changes the entire valuation equation for this business. Let's break down this 18.86% surge on the chart. The volume we are seeing today is immense. We are looking at trading volume that is already multiples of its 30-day average, and the session isn't even over. This isn't just a handful of traders on the Robinhood app buying Robinhood fractional shares. This is the unmistakable footprint of institutional money. These are block trades firing off. This is a fundamental, aggressive repricing of the stock in real time. Imagine the trading desks at major funds this morning. The algorithms at places like Interactive Brokers scanned the earnings headline, GRND beats on revenue, raises full-year guidance, and the buy orders were initiated in microseconds. Then the human analysts, the ones managing Fidelity Wealth Management accounts, had to scramble. They're looking at their spreadsheets, realizing their 12-month price target of, say, $12 was just breached in pre-market trading. This creates a cascade. Shorts, who are betting against the stock, are forced to buy back shares to cover their losses, adding fuel to the fire. Momentum traders, who use platforms like Sophie Invest for Sophie Active Investing, see the surge and pile in, hoping to ride the wave. And long-term holders, who have been sitting in their individual brokerage accounts watching this stock do nothing, are finally vindicated. This is a critical moment for the stock's chart. For months, GRND has been trapped in a wide, volatile range. Many investors who got in during the de-SPAC excitement were burned, a common story for that cohort of companies. But this pop today is technically significant because it is shattering several key resistance levels. If Grindr can manage to close the day above the $14.50 or $15 mark, that establishes a powerful new level of support. It signals to the market that this isn't just a one-day spike, it's a potential shift in the entire trading channel, a breakout. This is a very different driver than what we see moving, for example, Tesla stock, which trades on production numbers and Elon Musk's grand vision, or Nvidia stock, which is a macro play on the entire AI computing infrastructure. This GRND move is a bottom-up, company-specific story of financial overperformance. It's the kind of event that self-investing advocates dream of, finding a company the market misunderstands and being right when the data proves it. Many people using online investment platforms or simpler investing sites might be looking at this 19% green candle and wondering if it's too late to get in. Chasing a move this vertical is always high risk. But this is where genuine investment help is about separating the price from the value. The price is $15.06. The value is what this new, higher baseline of earnings and revenue suggests the company is actually worth over the next few years. The earnings didn't just beat expectations, they beat them comfortably. And, perhaps most importantly in this uncertain macroeconomic climate, management raised guidance for the full year. When a company expresses that level of confidence right now, while many other tech firms are cutting forecasts, it forces everyone to pay attention. They are seeing strength in their direct revenue streams, the subscriptions, which are far more valuable and predictable than advertising. This direct-to-consumer revenue is the holy grail. It's what separates a high-quality subscription business, which the market loves, from a volatile ad tech play, which the market hates. This performance now forces Grindr onto the radar of portfolio managers who might have ignored it before. Managers running Fidelity mutual funds or specialized Fidelity ETFs focused on small-cap growth may have previously seen GRND as too niche, too small, or too risky. But with this validated growth story and a clear path to higher profitability, it suddenly becomes a candidate for inclusion. This is why the volume is so high. It's the market collectively realizing it was underweight on a name that just proved its model is resilient. This is where an active Fidelity brokerage or Interactive Brokers trading platform becomes so useful. You can see the level 2 data, you can see the order flow, and you can understand the sheer demand that is driving this price. It's a far cry from a passive, intelligent portfolio, which might be balanced in large caps but miss this kind of specific event-driven opportunity. For those who are not as familiar with the company, what does Grindr actually do? It is the world's largest social networking and dating app for gay, bi, trans, and queer people. Its business model is freemium, which is a delicate balance. The core application is free to use and is supported by advertising. This free version builds the massive top-of-funnel, the huge user base that gives the app its network effect. But the real business, the part Wall Street is cheering today, comes from its subscription tiers, Grindr Extra and Grindr Unlimited. These paid plans remove the ads, allow users to see more profiles, add advanced search filters, and offer high-demand features like an incognito mode or the ability to unsend messages. The entire valuation of this company rests on its ability to skillfully and compellingly convert its massive free user into these paying subscribers. Today's report was the strongest evidence to date that their product team has found the right formula. They are proving they aren't just a dating app, they are a subscription-based social utility for a defined, loyal, and highly engaged community. This is a much more durable and defensible business model than one based on, say, the wild speculation seen in Robinhood crypto. Historically, as we've noted, the stock has been a battleground. Since its public debut, it's been lumped in with other speculative, high-growth, no-profit tech names. There were constant concerns about user data privacy, the potential for regulatory crackdowns in various countries, and intense competition from other apps like Scruff or even broader platforms like Tinder. The market narrative was one of significant risk and likely stagnation. Today's report is the first unambiguous piece of hard financial data to seriously challenge that entire long-standing bear thesis. So, this brings us to the future outlook, and the tension between expectation and reality resets itself. The new expectation, as of this moment, is that Grindr is a high-growth, high-margin subscription business. The market is now rapidly pricing in this new higher growth rate for the next several quarters. But here's the deeper reality check, the 15.06 question. Can they do it again? One fantastic quarter is wonderful. It resets the baseline. But the market, in its relentless fashion, will now demand that they beat this new higher baseline next quarter. The pressure is on. The risks haven't vanished. First, there's user fatigue. How many more features can they put behind a paywall before the free experience becomes too poor and users get frustrated? Second, competition. This success and the high margins it implies will only attract more and better funded competition. Third, the macro environment. Subscription revenue is sticky, but it's not totally immune. If inflation remains high and the economy slows, discretionary subscriptions are often the first things people cut. Is a Grindr Unlimited subscription as essential as a utility bill or a grocery budget? For many, probably not. On the flip side, the catalysts for further growth are now much clearer. International expansion remains a huge